Hello, good morning. Warm welcome to your decoding of the Economic Times newspaper. It is Friday and it is 10 a.m. Right time to decode the Economic Times newspaper. Just a quick disclaimer before I begin. I don't get paid by Economic Times to do this decoding. So reading the financial news is a part of my daily habit. It's a part of my daily routine. And inside of my commitment to make a difference to you, I am bringing some aspects from my daily reading for you. So that's the intention. And good morning, everyone. A warm welcome. I can already see people joining in. Do acknowledge your presence. Do let me know you're around. Hi, Alina. Yes, good to see you. Good morning. Okay, so today's topic is around index funds. So there is high demand for index funds, and there is low risk involved and high returns, because of which the demand for index funds is high. So that's the conversation for today. Hi Diksha, Mukta, Nidhi, Purti, Divya, Sneha, Pooja. Okay, we have two Poojas today. Good morning, my people. Hi Natasha. Good morning. Hey Savita. Good morning. Warm welcome. So let's begin. I'm reading first the first paragraph and we'll decode it together. Hi Arokya. So investors are increasingly buying low cost index funds across both asset classes. So there are two asset classes, debt and equity. Debt is also known as fixed income. So investors are increasingly buying low cost funds. So funds which cost low, which means the expense ratio is low in such funds. So across all categories, such funds have high demand. Data from the Association of Mutual Funds in India shows that the number of folios, so the number of accounts, okay, folios are accounts, the number of folios in index funds have doubled from 1.014 million in March last year to 2.342 million in February this year. So that's the huge shift that has happened. The number of folios have doubled in index funds. People are choosing them because they are high return and low risk funds. We have Santosh Joseph, who is founder of Germinate Investor Services. He's saying the number of new fund offers, NFOs, in index funds during the year has been far greater than from actively managed funds. So new funds, okay, new index funds were introduced in large numbers, and they were much greater than the actively managed funds, and this has attracted many new investors. Added to this are a number of broader index options. So during the past 1 year, several fund houses like HDFC, ICICI, IDFC, Access Mutual Fund, Aditya Birla Sun Life, Nippon Life, they've all launched a range of funds in the passive space to fill up the gaps in their product offerings. And in the equity space, there are a number of new fund offers which were introduced, and they were around Nifty Next 50. So these are all the indices in India around which the new fund offers, the new index funds were introduced. And the indices around which new funds were introduced are Nifty Next 50, Nifty 100, Nifty 50 equal weight, Nifty 100 equal weight, Nifty 200 momentum 30, and so on. So in the fixed income space, there were offerings of target maturity funds, and these were introduced considering the state development loans, government securities, and PSU bonds which were maturing in 2026-2027. So now I'm talking about what Vijay Kuppa, who's founder of Oro Wealth, is saying. Index funds are easy to understand. So why are they easy to understand? Because they simply just follow the index. Index are made up of stocks. What is index? Group of stocks put together. Index funds are group of stocks put together in one fund, and they just copy the index. The cost is low because there is no need to actively manage such funds. The proportion is the same. Whether it is stocks, whether it is anything else, yeah, it's the same. Right? So, our job is just to, when I say our job, fund manager's job is just to simply copy what is happening in the index. So, if a new stock is introduced, add the new stock. If an old stock is removed, remove that old stock. Keep changing the asset allocation as the index is changing it. So it's just simply copy pasting that has to happen. So there is no need for active management here. That's why it's called a passively managed fund. The expense ratio, which means the cost of managing this fund, is really low, and so it becomes really a low cost fund. And then the returns are high. It's just copying the index. That is all that it is doing. So he's saying index funds are easy to understand. They save costs due to low expense ratio. There are no surprises in the portfolio. Investors increasingly like debt index funds due to visibility of returns and low credit risk. Yeah. He said that while earlier index investors bought primarily Nifty 50 index fund, today there is increased demand to buy into plain vanilla indices like Nifty 100, Nifty Next 50, Nifty Mid Cap 150, Nifty Small Cap 50, Nifty Bank Index, Nifty Equal Weight 50, and Nifty Equal Weight 100. So investors have also started nibbling in factor funds that combine equity, growth, momentum, and more. Financial planners are pointing out that many do-it-yourself investors, so investors like you and me who are doing it yourself, who are doing it ourselves, so would like to buy for long tenure. They stay away from active funds due to high cost, possible change in fund management, and fears of underperformance. So these are all the fears which are around the actively managed funds. There is, of course, a fear of the fund not performing, the fund manager changing, right? High cost being involved. So index funds save you from all these fears, and so some do-it-yourself investors prefer index funds. That's what financial planners are saying. A Nifty 50 index fund can cost you 6 to 20 basis points, while an actively managed fund could cost you 75 to 125 basis points in a direct plan. For an investor looking to invest for a long tenure, this could result in significant savings. So if you reduce the cost, you maximize your returns. That's the key. Okay, hi Sweta, Kanika, good morning Kaveri, Deepti, Ishita, welcome my people. Start typing, what are you guys getting? Kaveri saying, in a volatile and uncertain market, maybe people are playing it safe. Risk appetite is low in these times. Yes. And it is an uncertain time. First it was the coronavirus, now it's the Russia-Ukraine war. So something or the other just keeps happening and the market just keeps moving. I don't know if people are playing it safe because of the volatility right now, but yeah, I think people who don't want to get into actively managed funds despite all the alpha, despite all the returns that get generated, then yeah, that's the thing. I think it's more about your personal risk appetite. Returns will never beat the index. No alpha. Yeah. Of course, there are many indices. Pooja, you second Kaveri. Maybe not for someone looking to take higher risks and make more money. Yes, but you guys are also not taking higher risks. I mean, you're taking calculated risks. You guys have used the step-by-step methodology to pick good quality actively manage mutual funds and now you've invested in them after careful study and you're keeping a tab on them. I don't think there's so much risk. Really, this is more like calculated risk. And yes, if there are people who don't want to manage even a little bit, okay, I think I'm back. The internet went for a second. Okay, I think I'm back. So I was saying something, right? Yeah, I get distracted, right? When the internet just shows that it's going off. But yeah, it came back. I think I was saying something around the index, and I was saying that yes, you guys have taken calculated risk, and calculated risk is when you have actively studied and actively managed fund, and you are now, every 6 months to 1 year, you're keeping a tab on the changes, and that's enough to put finances on an autopilot. But yes, people buying index funds, they're sometimes not even wanting to put the finances on autopilot. They just want to invest and forget. So, well, that's a completely different space. Yes, Natasha, calculated risk. Absolutely. Kaveri, for people who don't want to bother with studying, this might be an easier option. Yes. So people who don't want to study at all, don't want to put in any kind of effort. But yes, index fund also requires a little bit of effort. I wouldn't say that there is no effort. There is little bit for everybody. It's like that. Okay guys, so thank you so much for listening. Please start typing. What are you getting? What are you taking back for yourself from this video? What are you learning? Quickly share your learnings, guys. Sakshi, can this be a good option for starting investments? Yes, it can be. But if you don't understand index funds, or if you don't understand the investment you're doing, don't get into it. It is a good starting point, yes. At the same time, it's a starting point for people who understand it. Yeah, no blind investments. That's my recommendation, and rest completely on you. Kaveri, you're glad that you understood, and you still you're still able to stick to your choices. Got that? Thanks to Women on Wealth. Thanks to you, who is learning, who's growing, who's making sure she is really managing her finances. Okay, what else, everybody? I want to hear from more people who are watching. What are you taking away? What are you learning? Hi Sangeeta, good morning. Purti, index funds could be studied. Okay, yes, for sure. Ishita, keep it simple for now and stick to what you've researched. Accordingly, make investments. Absolutely. No study, no understanding, no investments. Okay? You're not going to create sustainable wealth with that kind of functioning. Understand it. Okay, what else? Nidhi, Sarita, who else is around? Who all said they're around? Deepti, Arokya, Pooja, what are you guys taking away? Sneha, Divya, Nidhi, Mukta. Okay, Savita, you want to understand more about index funds? Well, the video is right there in the Mutual Fund Mastery series. Go back to your course. It's right there. Sakshi, how to study index funds? Sure, in the Money Gym program. Sakshi, are you a part of the Money Gym program? Pooja, maybe I will look at index funds for my kids' education. You could. Planned investing, Nidhi? Got it. Sweta, you need to explore index funds, okay? Mukta is saying, thank you for making me understand how to select mutual funds. It's my absolute joy to be supporting each one of you. Thank you for listening in, my people. I close the live here. Thank you for listening in. And if you're benefiting, please spread the word about Women on Wealth to people in your life. Who knows who is looking for financial education? Who knows who is ready to make her own financial decisions? Do spread the word and let us together march towards the mission of 50 lakh women wealth creators created by 2030. Let each woman, okay, let at least each household has a woman wealth creator. Got that, Sakshi? Alina, you're sticking to the money gym to learn the index funds more? Sure. Kaveri, 5 months ago, this would have been worse than Greek and Latin. So stoked that I can understand all that you're talking about. Got that? Thank you. Purti, can't brush off anything just because it's not studied. Take charge, everyone. Stay safe. Bye-bye. Loads of love.